we are back again here on the Building Equity Podcast. My name is James Schlimmer, Chief Executive Officer of Equity Real Estate Service, and with me as always, Mr. John Bowens. How are you, sir?
I am awesome today, James. Thanks so much for having me here again. And today we have a pro guest, real estate professional guest with us. You want to introduce our guest?
We can do it. We're sitting here with a Florida real estate attorney from the law firm of Grant, Cottrell, Miller Myers out of Naples, Florida, Mr. Jeffrey Grant. And one of the things that we talked about early on with what we wanted to be able to provide for entry-level to intermediate real estate investors are professionals. We wanted to bring them on to the show. And how do you get started in real estate investing? You know, how do you get the granularity behind substantive conversations in this world? And we kind of feel like, Jeff, that's what's missing. So thank you so much for joining us.
Thank you guys for having me. Great to be here.
Now listen, we like to start every show. These are kind of the show, but it's the news, the real estate news that you should care about. And if we do that, we got to do that and mention our sponsor, IRA Title Pro. And are you buying or selling real estate using your IRA? I know that you are, John Bowens.
I am, lots of it.
Okay. On your next real estate investment transaction, try closing with IRA Title Pro. Enjoy a full-service title company that focuses exclusively on IRA real estate closings. Enjoy faster close times and experienced closing teams that also understands fractional IRA interest in the property, which is a little bit challenging sometimes. Awesome proactive communication, competitive closing fees, and you can find out more at iratitlepro.com. So that's we got a sponsor, Jeff Grant.
Good deal.
That's the real deal. Now listen, for the news story, we are filming here in February of 2022. So this is from The Guardian. This is literally today. It's about 3:30 p.m. Eastern. And it kind of seems like there's rumblings that are happening with Russia and Ukraine, as we've all heard. And that may be starting. And at least what some of the popular shows have said, the stock market may drop by 10% if Russia was to invade Ukraine, right? And what I find fascinating about that on a real estate investing show is that, are your tenants, John, going to pay their rent on March the 1st?
Most likely, they're going to continue to pay their rent. And more importantly, the value of that property should stay constant. I don't see why there's any reason, if something happens in the stock market, why the value of my real estate is going to change. So I'm not overly concerned about this.
So
personally,
I feel terrible for what's going to happen or what may happen there. So obviously prayers are with everybody there. But one of the things I was joking around with John about just prior to this is, let's see if I can get this to come on. I was like, why would the stock market drop 10% because of Ukraine? And
global impact, right? This is what we see regardless of what's happening in the U.S. Things would be great. You know, if something happens in China, Russia, Ukraine, wherever, you know, you pick the country, this is what we see happen to the stock market. Now, oftentimes, you know, it's just for a very short duration, and then we see a quick recovery. You know, a great example is when the pandemic hit. Now, not an apples-to-apples comparison, but when the pandemic hit in, call it February to March of 2020, we saw the stock market drop by about 20%. Now, there was a pretty quick recovery there.
Yep.
But, you know, James, I can tell you about 3 months prior to that, I was at a family party, and my uncle comes to me, and he was, you know, if you will, boasting about how his stock portfolio, his portfolio of mutual funds, his retirement account portfolio, had grown by over 10% over the last 6 months to a year. And he was looking at me like I was absolutely crazy for owning real estate in my retirement plan. I have all these people in my family that think it's just absolutely absurd to own real estate in a retirement plan. Now, we know that there's really good reasons for that.
Sure.
And so sure enough, this individual called me when their portfolio had dropped by 15 to 20%. So
March of 2020, it dropped.
Right,
Yep.
took a 15 to 20% haircut. And now this same individual that was just telling me I was nuts to own real estate in my retirement plan is asking me, what do I do? Now, fortunately, this individual was able to recover from much of those losses. But not everybody was in that type of situation. You know, some people panicked and sold and took that haircut and weren't ever really able to recover from that. You know, meanwhile, I had investors that needed to close on properties. So they had offers on properties, but they hadn't sold their current retirement, their current positions in mutual funds and stocks. And so they couldn't justify taking that loss.
Yep.
Some of them had to delay the closings, or some of them actually had to back out of the deals altogether,
Yep.
and they missed out on that opportunity.
Well, one of the things we looked up here, and I think we're at the United States Treasury, I guess is his website here. And behind the scenes, we go down these little rabbit holes, which you're familiar because we used to go down a lot of rabbit holes,
All the
right?
time, all the
And you
time.
got to look up, and it's like, all right, well, really, what do we import from Ukraine? And you can see here, what is total imports? $143 million. We get fruit, vegetables, snack foods. It's amazing. Dairy products. So we're getting about $140 million. But the other interesting thing here, if the internet doesn't go out, let's see if we can get this back. Here we go. There was a good almost $500 million. We're having a tough time here. It's going to fight it. It was almost $500 million in foreign investment we inject into Ukraine. And you got to think somehow all the ebbs and flows, they're invaded, which is unfortunate, but this is why the markets are affected, right? Long story short. So I say that because we are a podcast for real estate investing, and we've got experts like Jeff Grant here. And to hit you with one of the first questions is, I'm sure in your practice you are working with folks that are maybe investors or just getting started. And why would I, for instance, I could buy a property in my name individually. Why is that a bad idea if I'm doing real estate investing? I'm going to put a renter in there, let's say.
Sure, if you're doing real estate investing, it's a bad idea. You want to put a layer of protection, whether that be succession protection or asset protection between you, your potential tenant, and your potential tenant's guests. And there are several different ways you can go about doing that depending on the sophistication level, the long and short-term goal of that particular investor, and their stomach for complication.
Okay, so let's just say our intent is a long-term rental, like John, what you do, right? And John, you're holding the properties in your IRA, right?
Right, that's correct. Now, we have properties inside and outside of our IRA.
Okay.
And we form, for our properties outside of our IRA, and now the IRA is a separate conversation, which
Yep.
we can get into, but I think for now we can focus on, as we talk about building equity, let's focus on the taxable environment. Let's focus on building a rental portfolio outside of our retirement plan.
Okay.
So for our rentals outside of our IRA, we hold those rentals in an LLC. Now, if we're going to go get a bank loan where we have to close in our personal name, so we're leveraging our W-2 income like we talk about, don't quit our job. That's what we talk a lot about on this show, by the way, Jeff. Don't go out and quit your job. Keep your job.
We feel like everything out there right now is telling folks, don't own a home, just go over leverage yourself and make billions of dollars and you'll be flying around in a private jet. It doesn't really work that way.
Right.
Haven't seen it.
Yep.
So, right. And so we close on the property and then we transfer to an LLC for asset protection purposes. Now, obviously, you want to make sure you work with your bank on that because there are due on sale or due on transfer type things that you have to look out for. But that aside, we leverage the formation of the LLC for asset protection purposes, and we don't go to a online click a couple buttons and form an LLC.
Yep.
We go to our local attorney, which I know there are a lot of folks here local that work with you, Jeff, to do that. So that being said, what I'd like us to do, and if you can elaborate for us on this, Jeff, is talk about that whole process for a brand new investor that's coming to the show, that's buying their very first rental property. What's the first step in terms of forming the right LLC and then going through the process of making sure that that property has the optimal asset protection?
Sure. So the initial step would be the formation of the LLC.
Formation of the LLC.
Because the formation of the LLC is not necessarily specific to a particular property. So if you have somebody who has the idea that they're going to go out and they're going to buy an investment property, forming an LLC first is not necessarily a bad first step.
Okay.
It forces you to come in, think through your ownership structure, whether you're doing it yourself, whether there's a partner, whether your partner is your spouse or not, right? So we get them formed in an LLC. We prepare what's called an operating agreement. We get everything filed and approved by the state so that they're ready once they're able to select a property, close on it, and then get whatever approvals they need to from their lender to transfer the property into the LLC, that structure is in place. So that when they go looking for prospective tenant, the lease is in the name of the LLC, and they can start their compliance work and their tax prep all appropriately.
Can I ask an elementary question here? So you say asset protection. And I feel like if I'm a brand new real estate investor, that sounds like a really sophisticated phrase and like, wow, I got to have asset protection. But what could go wrong? So what am I protecting against?
Sure, asset protection is a very, very broad term that's used and misused in the legal world all the time. But really what you're trying to protect against is any liability from your tenant. They hurt themselves on the property.
Yep.
They hire an unlicensed contractor to do some repairs. There's damage to the property. Your tenant's guests hurt themselves on the property. You have a dispute with your tenant about the condition of the property or the lease, or if there's an eviction matter. You're putting a layer of protection with the LLC between yourself and the tenant.
Yep.
Your tenant, to an extent, might not even ever need to know your name. They can look and see they're writing their rent check to James Schlimmer LLC or whatever creative name you want to choose.
Yep.
You're putting that layer between yourself and your prospective tenants and their guests and so on and so forth.
So now you set up the LLC and we got an operating agreement. That allows us also to be able to get a bank account,
Correct.
right? And now what we're doing is just elementary school here. We put a tenant in place, right? That lease is between, who's the landlord?
The LLC
The LLC
and the tenant.
and the tenant. And those lease payments are being made to
The LLC.
the LLC, right? So it's kind of like, I feel like it's, well, like, duh. But if you're brand new and you never did this, you're just willy-nilly.
It's a business, and I think this is important, James and Jeff. I know, and jump in here, please.
Sure.
Is when we own rental properties, we treat it not just like an investment. It is an investment, but we treat it like a business. In a business, we have an entity, an LLC. We have a name, and my wife and I are managers. We're property managers. So when we present ourselves to we call them residents, not tenants. When we present ourselves to residents, I'm John Bowen's property manager, not John Bowen's owner.
Yep.
And when I'm talking to a resident about them having trouble making payments and having to pay a late fee, I let them know that the office's policy is that there is a late fee of $50. So you owe $750, you didn't make the payment, you had a 2-day grace period, you missed that grace period, and so now you owe $50. That's our office policy.
Yep.
So you notice as a property manager, and I'm sure we'll have another segment all on kind of the logistics and some of the psychology behind this, but we're running it like a business. And so it's not going to johnbowens@gmail.com. It's going to jbowens at our business name. I'm not going to mention our business name because I like to be anonymous and private. I don't want people looking up the houses that we own and such.
And I think that's an extremely important point because a lot of first-time investors will go out and they'll form an LLC. Maybe they won't take the step to go see an attorney and they'll do it online, and they won't open a bank account in the name of the LLC.
They never open a bank account.
And they will commingle that money, and the emails will go to johnbowens@gmail.com.
And they don't have an operating
And they
agreement.
don't have an operating agreement, and you've thus basically ruined any of the asset protection components of the LLC by commingling it so badly.
And it's so affordable now to work with a licensed attorney in a local market and form an LLC. You know, I can speak from experience because I think a lot of investors, when they're first time doing this, they get very intimidated by the concept of talking to an attorney or meeting with an attorney like Jeff.
Right. He's intimidating.
Well, he doesn't seem intimidating to me, right? You know, and it's attorneys like Jeff that want to talk to their clients before the problems happen, right? And so in my experience, I had a 45-minute consult with our attorney. He's a real estate investor himself.
Can we cut right there?
I'm having lots of problems then.
And I'm going to take your wire here.
Oh,
which is
sure.
Showing. And
I'm going to move the...
let's put it on the side.
Sorry.
Yeah, that's great. Cool, I think. Be a better look. All right. And then, John, we're still rolling with everything on pop.
Say the 45-minute consult again,
Okay.
just because, and then let me jump in.
How did I start that whole segment?
It shouldn't be intimidating to go see a lawyer.
Yeah, it shouldn't be
All right,
intimidating.
good.
Go-
I'll start from
and
there.
hit it.
Okay. You know, it should not be intimidating to go speak to an attorney. In fact, in my experience, most attorneys, and I'm sure Jeff can attest to this, they want to talk to folks before the problems happen. So instead of being reactionary, let's be proactive. In my experience, when my wife and I got together and decided we were going to do this and form an LLC to own real estate, we met with a local attorney who is a real estate professional, actually owns properties himself, and has worked with a lot of real estate investors, came recommended. So someone like Jeff in the Cleveland area. And we had a 45-minute phone consultation, and he asked a lot of questions about what our goals are, what we're going to be doing, and he made sure to be very clear that, okay, we're going to form this entity for your buy and holds, and if you want to do some fix and flips, we're going to form a different entity for very specific purposes. Also, tax purposes, which I know in another episode, we're going to have your friend BJ on, which he's going to talk a lot about from a tax perspective, different types of entities. But to stay focused on the asset protection piece, it was a 45-minute consultation. And it didn't cost me $10,000 to form an entity. It only costed me $1,000 to $1,500.
Sure.
To me, it's worth it.
It makes so much sense to reach out to a Jeff and I say, pay for an hour of your time and let Jeff understand this is your circumstances, this is what you need to do, and set it up the right way up front. Because the alternative, can you give me like a horror story? You mentioned like the commingling of the accounts. But what is a horror story for someone that does it wrong?
Tenant gets sick on the property. You have a tenant in there, maybe there's some mold issues, maybe they're real, maybe they're not, but you have an instance where property was owned by an LLC, checks were written to the landlord personally, everything was through the landlord. The landlord helped. The landlord was the handyman, the bookkeeper, everything.
Yep.
And when there was a lawsuit about that mold and about the potential illness, it was with the landlord personally. They basically sidestepped the issue of the LLC. Additionally, we've seen situations where folks thought there was an LLC involved because they set it up once themselves and they failed to pay the annual renewal,
Yep.
which is a big one. We see
Yep.
that, we see that a lot. Only to be told, hey, look, you have no asset protection. The state dissolved the LLC for failure to do the annual filing. You have no protection. You're now liable to all of this. And by the way, all the contracts you signed are void because you didn't keep up with the LLC.
So let me just ask you this, because I think that was just fantastic. And for some folks that are brand new at this, it's you may have all the intent in the world and you create the LLC, but yet, hey, you want to roll up your sleeves and do the work.
Right.
You're building a case against you that James Schlimmer individually is showing up to fix this stuff. James Schlimmer individually is accepting rental payments. James Schlimmer individually, and what you're saying in that case is they were able to prove all of the individualities
Right.
and sidestep the LLC.
I mean, I think John's scenario a few minutes ago was extremely sharp. The idea that you're the property manager, 123 LLC owns the property, you're
Yep.
the property manager on their behalf, and to run it like a business. By the way, if you do that, it also becomes a lot more of a scalable business, right? Because you're building the mousetrap once, and then you could do it for however many properties. But in the instance with the person with the mold, I mean, they basically erased all of the good that they had done by setting up the corporate entity to do it.
And what we're talking about here is that those tenants, and the attorneys representing those tenants, now go after that individual, which means all of their other properties, assets, bank accounts, everything can be accessed. Whereas with the LLC structure, and I know there are extenuating circumstances with that, negligence, things like that, I'm sure we could talk about that, but by and large, that lawsuit is against the LLC. Could you, Jeff, maybe comment a little bit on exactly what that means in terms of the claim against the LLC versus the individual and how
Sure.
it may only be the LLC assets that are at risk?
Absolutely, and I would caution everybody that these are state-specific questions. So,
Yep.
and it's a relatively complex analysis, but at a base level, when you sue a corporation or an LLC, that LLC's exposure or that entity's exposure is only what that entity owns and holds. When you sue somebody personally, their exposure is everything that they hold, right? So if you have an LLC that owns one property and has $10,000 in the bank, if somebody sues them, rightly or wrongly, their exposure is the ownership of that property and the $10,000. You don't get to touch the owner's primary residence, the money they have in their bank accounts, their other investments, any other properties that they may have. You don't get to touch that. Whereas if you own the property in your own name and you own 3 or 4 rentals in your own name and somebody gets hurt on one, they get a judgment against you, well, guess what? That judgment now attaches to all of the other properties and the bank accounts of that owner.
Okay, and then that brings us to the next question that I know a lot of our viewers have, which is, I've heard of this concept of a series LLC, where every property that I own individually, I would form its own individual subsidiary, if you will, LLC, and then all those LLCs will roll up to, let's call it a mothership, a
Right.
sort of master holding company, LLC. Is that something that you see commonly? We're not here to recommend or advise anyone, and obviously, like you said before, very important that it's state specific. But do you have any kind of commentary around that whole concept of the series LLC?
For folks who own multiple properties and their intention is to own and hold and rent out multiple properties, it's a very common strategy. It's also an extremely common strategy for folks who own vacation rentals, something we're seeing more and more.
And when you say vacation, you mean all short-term rentals?
Short-term rentals.
Okay,
yes.
short-term rental. Got it.
Yep, because the liability on a short-term rental, right, is significantly higher than the liability on a long-term rental. Instead of having one family through your door a year, you might be having one family through your door every week, right?
And on the vacation rentals, if I have a long-term buy and hold, and then I have a vacation rental, can there be risk if I'm holding both of those in the same LLC?
Yes, at least in Florida, the compliance work is significantly different. A vacation rental or a short-term rental, you're paying short-term occupancy taxes and sales taxes. I mean, there's all types of different exposure on that you don't have on a long-term rental.
Yep.
Can you define for us, Jeff? I think it's important to define how do you determine whether a property is considered a short-term rental or not? And I know there's some nuances there that might be state specific, but just kind of generally speaking, what would viewers want to research in their local market in terms of what defines it as a short-term rental versus a long-term rental?
So in Florida, the legal definition of a short-term rental is anything less than 6 months.
Yep.
Right? But when we use the term vacation rentals, often we're talking about Airbnbs, VRBOs, things of that nature, which of course the commonality of those is increasingly becoming increasingly common. But in Florida, they deem anything less than 6 months as a short-term rental. You have to pay occupancy and sales tax. Basically, it gets treated almost no different than a hotel.
Exactly.
In the eyes of the law. So your exposure there is drastically different than your single-family house that you rent to one family on a 12-month lease.
And I assume that insurance, and not that this is an insurance episode, we'll have another episode on that at some point or another, but would it also be reasonable to assume that our property insurance and our liability policy insurance would be different for a short-term versus long-term?
Absolutely, they should be. Oftentimes they're not, but they should be.
Wouldn't you think that oftentimes most people aren't really disclosing what they're really doing with the property?
Absolutely not, no.
Okay, right?
So I got some more questions here. And by the way, for all of our viewers, the reason why I am in a machine gun fashion asking Jeff questions is because, as you can imagine, he is a licensed attorney actively practicing, and it costs money.
This
right?
is our chance.
And so this is our opportunity for our viewers to get as much free information as
The
possible here.
cheapest way to do it is to create a podcast and all the production and get an attorney on. You can ask him all the questions you want.
Exactly. That's
Yeah.
why James and I did that. No, okay. Joking aside, I don't want to move just yet away from asset protection and into estate planning, but that's going to be the next bit that we're going to go through here for all of our viewers out there. Okay, but staying on the asset protection piece and the formation of the LLC, we've been talking about buy and holds. Let's move for a moment to what if I'm an investor that wants to do buy and hold, and then I also want to do some fix and flip transactions. Can you comment a little bit on what I might want to do in that respect?
Yes, I mean, obviously everybody's situation is custom, but the general advice would be to segregate those out. Your liability level and your intention and your goals on a fix and flip or a series of fix and flips is drastically different than that for a buy and hold. Right? For a fix and flip, you're going to have a lot of people through there on a short-term basis, and then the goal obviously is to unload the property. So, for instance, you might be able to have one LLC that you use for fix and flips, and you just keep using it. Right? It owns one property at a time,
Yep.
maybe even two properties at a time. Whereas there's a lot of logic, depending on your situation, for your buy and holds, that each one has its own LLC, and that's where actually you often see the series LLCs, because the series LLC, the holding company owns the buy and hold LLCs and the fix and flip LLC.
And then on the separate LLCs, would you, and I'm starting to bleed a little bit into the tax realm.
Yep. I was going to go there myself.
But I want to go there for just a second and comment, and then we'll move on quickly. Would you set up that separate LLC from a tax perspective differently than the LLC for the buy and holds? And is that relevant when you're actually forming the legal documentation, that is the operating agreement?
I don't want to step on the shoes of your local tax advisor or on BJ, who I know is coming on shortly. But my recommendation would be yes, because you're going to look at your buy and holds drastically different than your fix and flips.
Okay. And by the way, for all of our viewers out there, we are going to have a future episode, where we have both Jeff and BJ
So you
that
got
are going to be on together.
You got the real estate attorney, and you've got the tax preparer going at it.
Right. So call this like all bundled up in 3 episodes. All right. So let's move that aside, and let's move on to state formation. So I have been to these, seminars, these national companies, and I don't want to speak ill on these companies, because I think many of them do a good job in a lot of different areas. But it seems as if they kind of have a systemized approach where they refer their real estate investor students that are part of their group to some of these national companies that are setting up like Nevada entities or Delaware entities. Now, my attorney, I'm in the state of Ohio. I own real estate in the state of Ohio. That's it. That's where we invest. That's where we're from. So my attorney said, you need to form in the state of Ohio. That's the way you should do it. But Jeff, could you comment on owning or having an LLC or setting up an entity that is domiciled in a separate state from where you're actually investing?
Sure. There are certain states that have stricter confidentiality rules for corporations. Delaware, Nevada.
Sure.
Oftentimes those are used in several instances. One, if it's a relatively large purchase, and multifamily apartment complexes, apartment buildings, etc. Or you have somebody who there is an extreme need to shield somebody's identity. Instances that we've seen over the years where it is a officer in a publicly held company who does not want anybody to know. We happen to live and practice in a heavily retiree area.
Yep.
We've had an instance, and it was many, many years ago, where a gentleman did not want it to be known by anybody mining data that he was buying a large vacation home in Southwest Florida for fear that it would tank the stock of his company, that the thought that the founder and CEO was retired. Mm-hmm. So, and scenarios like that. We've seen celebrities, professional athletes will do things like that occasionally. But for most folks, it is unnecessary, impractical, and overdone to try to go to a Delaware entity or a Nevada limited partnership or a North Dakota trust or any of these other entities that you use to keep your name entirely out of it.
Mm-hmm. And I'll stop there for just a second. And Jeff, you may not want to say this because you don't want to over promote yourself. Although, I think it is important for people to understand that you are a practicing attorney and you're, open for business, so to speak.
Sure.
But it's so important to visit with your local attorney that works in that marketplace and sit down and have a conversation. And that's why, from my experience, having that customized approach to make sure your operating agreement is drafted properly. It's not a boilerplate document that you downloaded online or went through one of these, large aggregators. I can't stress to investors out there the value in working with a local real estate attorney that's a professional in that area. So with that aside, that's like one of the pro tips that we have here, I guess you could say.
I can't tell you how many transactions we've tried to close where it's an LLC and they don't have an operating agreement and there's 2 members. And we don't know where the one member is or the one manager is. I mean, and you're just saying, where is this person? And you'd be like, oh, well, and inevitably what's always said is nobody's ever asked for that before. And the part that I think people need to understand is you may be able to buy the property with this LLC because title company will put anything on the deed if you want to acquire it in an LLC. But when you go to sell it, that's where the title company wants to be able to prove who has the right to be able to sign on behalf of that entity. And if you have multiple people because you're just starting and you're starting a business like John and I are doing this together, and there's no way to verify who has the ability to sign on behalf of that LLC. Is it just James? Is it James and John together? Is it just John? Is it just James for this property and just John for the other property, or who knows? You can't sell the property. And so many people get themselves in this where they can't unload the property because they did everything wrong on the front end. And then it costs you big time money to get it fixed. So you think you're being slick or smooth by avoiding a $500 initial consultation or a $1,500 to get everything set up on the right way, but you're killing yourself because you can't sell the property.
You can't put a value on the discussion of doing the planning work correctly up front. I mean, it will save you time, money, aggravation in the long run on a massive scale.
So let me set this up. Our investors do everything right. They've got 5 properties. They have made their way. We'll talk about Kevin and Cynthia, right? That you talked about. They're at the end of their journey, right? And they're thinking about, well, geez, where do I want all this stuff to go? We've been able to acquire over 15 years. Maybe we have $1 million, let's just say, in properties. And, well, what happens if I die? How do I get this to my kids? Or how do I make sure that both of these kids have it? And what I'm talking about here is just like estate planning,
Sure.
And succession planning. And you brought up a lot of folks make the difference, or they believe that with their asset protection, they have succession protection, and they don't. Can you touch on that?
Sure. Oftentimes that is not the case. Now, it is possible to customize an operating agreement so that a property is left to somebody after death, right? So the ownership in that entity that owns that property is left to somebody after death. But that's not done frequently. So, folks often will say, well, I own my properties in an LLC. Why? It should go to my kid. Or I own the property in my land trust. Why is it not going in accordance with my estate plan? And the reality is your estate plan and your business plan really need to go together. We've used the term succession plan. I'm going to use the term estate plan because it's part of a broader conversation. But if you're a real estate investor and you're going and making these choices and you've accumulated this portfolio, you need to go back to whomever helped you set up this structure and talk about your estate plan and your succession plan. Because if you don't and these pieces float out there on their own, it's going to be a sizable expense and headache to your family in administering these.
So what worst case scenario, what happens? I die, and then my son's going to get my properties, right?
Maybe not. Is there a spouse? Is it a first spouse, a second spouse? Is the child the child of that particular spouse, right? Where are the properties? Are they in multiple states? Then we're talking about a court process, probate, potentially in multiple states, right? I practice in Florida, and there are a large number of people here who are from elsewhere, right? And we talk to our clients a lot about, hey, look, if we don't do the planning correctly, you not only have a probate process in Florida, but you have one in New Jersey too. And
average cost of a probate?
Somewhere between $5,000 and $7,000.
And so probate, let's talk about that. Okay, so let's say I have a will. So I get this a lot from people. They say, well, I have a will. Does that actually avoid the probate process? My understanding is there's still some other process that they have to go through, but could you let's start with, okay, let's say I have 10 rental properties and they're all owned in an LLC, and I don't have the customized LLC because I don't think most people have that. I certainly don't have that. And I pass away, but I have a will. What happens at that point?
So there is a probate needed to transfer the ownership in those entities to your heirs. Now, we say transfer the ownership in the entities, not the properties, because the properties are owned by the entities.
Yep.
So in this particular example, it's important to point out we're not actually transferring the properties. We're transferring your stock or your membership interest in those LLCs. So probate differs widely from state to state, but probate is a judicial process where the will is filed with the court, certain guidelines are met, notices provided to all of your creditors, and there is a legal and statutory process to distribute assets out. Now, probate can be time-consuming and expensive. It also provides an avenue for grieved heirs, relatives, whatnot, to come in, make a claim, and you could have a court fight. The probate litigation is a cottage industry.
So even if I have a will, I don't avoid that probate process. I don't avoid that judicial process. Is there any way for me to mitigate all of that burden that you just talked about?
So to break up your questions, yes, even if you have a will, you still have to go through the probate process. The way you mitigate that is doing trust planning. I refer to them as revocable trusts. They're also commonly referred to as living trusts. Fundamentally the same meaning. What you can do in a trust is a document where you can lay out your wishes, similar to a will. I want such and such to go to my son, I want such and such to go to my daughter, I want my wife to get X. And they're documents that can get rather complex depending on the needs of the individual client. But if you set up that trust correctly and you title your assets in the trust, then when you pass away, distributing out those assets is a clerical act. And you've avoided the probate. So for a small amount of expense and planning up front, you've now mitigated the need to have a probate in Florida, New Jersey, and Michigan, where you have 3 properties.
So when you say have the assets in the name of the trust, let's say, for instance, we have 10 rental properties and those are all deeded into, LLC.
Right.
Do we need to redeed those into the trust?
The ownership interest in the LLC can get assigned to the trust.
There you go.
So we don't have to transfer title.
Right.
Nope.
Perfect. So even if I came to you today, Jeff, I have my LLC, I got, let's say, 10 properties, or maybe I got the series LLC, however that works.
Right.
I don't have to worry about, extra filing fees and deeding of properties and changing everything. I can essentially set up this revocable trust or whatever type of trust is applicable to the situation based on the recommendation of my attorney. And then I'm simply just transferring the units, the membership interest of the LLC. Right. Properties don't change.
Right. And to plug the concept of the series LLC, if you go the series LLC route, not only do you not have to retitle the properties, but you're only transferring the interest in one entity.
Which is way simpler than all the other ones.
Right? Because you have one LLC that owns all these other
Yep.
entities, you're only transferring the ownership interest once.
Right. Now, the revocable trust, can you share who would be the trustee of that revocable trust?
So initially, it would be the folks who set it up. So if my wife and I have a revocable trust, and we are the trustees of that trust. If something happens to one of us,
Yep.
the other is the trustee.
Can you go into, so when you say trustee, it's just an easy way to say who can make decisions on behalf of the trust,
Correct. Who administers it, who can make decisions, absolutely.
right?
And then after you pass away, somebody else is a trustee of the trust. It can be a relative, it can be a son or daughter.
It can be an
a
attorney.
friend, it can be an attorney, it can be a bank, depending on your needs and the complexity of the situation. And that's where really a qualified estate planning attorney can sit there, drill into the family situation, and have a discussion as to what's going on, where the vulnerabilities are. Oftentimes, and we do a tremendous amount of estate planning work, you'll sit there with a family and you'll be able to point out the vulnerabilities, regardless of what the folks think. And they may swear to you that their children are all wonderful people and they would treat each other phenomenally, but having done enough of these, you can usually poke and find.
Right.
So how often do you find, and I imagine you may say a lot here, so it's kind of a softball, but where people are scrambling at the last minute to get this stuff done right, as opposed to John's point, hey, you're opening the door, you're saying, wait a second, Russia's going to invade Ukraine, the market may drop by 10%. How do I hedge against this? I'm going to start real estate investing. How do I do this the right way? And on the flip side, you have folks that are at the last minute now towards their later years, and they're trying to scramble and do all this stuff. I mean, do you get a lot of folks that are already sick? And
We do. We do. Over the years, we've had plenty. We've made ER runs, ICU runs, going to skilled nursing homes, house calls. I mean, it's part of the practice. It needs to be done to help some of these families. It happens too often, particularly down here, the population demographics to an extent.
sure,
But obviously, the value in the time, money, and expense of doing it up front is immense.
I imagine the stress level for all of those parties when you're scrambling is through the roof,
Oh, absolutely.
right? Whereas you have the ability to be, I say, sophisticated and just be proactive and knock this out. And I really want to hammer the point, because what you're saying with the living trust, and you pass away, you're avoiding probate.
Correct.
So you're avoiding a judge to make a decision on what's going to happen with all of your assets, even though you may have had a will.
Well, the judge's role in a probate is really to administer the terms of the will. But what you're doing is you're eliminating a sizable expense to your family.
Yep.
You're eliminating the possibility of your assets being frozen or being slowed down in their ability to distribute out. And you're eliminating an avenue of dispute for aggrieved family members and heirs, which is something that we deal with a lot. It's unfortunate, but families are difficult.
It happens.
It happens.
And let's be honest here. When people have to go through that whole probate process, now you become a target for people to come in and buy your properties at a much deeper discount. Whereas if you have this set up properly, and this is, investors target, right? They look
Sure.
at,
They
we're
look
talking
at
about
the
obituaries,
clerk,
right?
yeah.
And so, now you have everything set up properly where there's a layer of anonymity there. And if the exit strategy for the heirs is, hey, we really need this money and we want to liquidate, then they can do that. Or for some families that have enough wealth, they may not want their children or their grandchildren or maybe their children's spouses, right? To be able to go and just take the money out, at their will, so they can build within. I know I'm stealing a little bit of your content here, but you can build within the trust, those specific parameters, so that you can put in control, so that people don't go run off with all of your money that you worked your entire life for really hard.
Absolutely, critically important. Those vulnerabilities do exist. I could bring you junk mail on a daily basis of solicitations we get from realtors and investors trying to pick up properties that our firm is running probates on.
Yep.
On a laughable level of inexpensive. So that is real. I've had clients call me in tears that their loved one just passed away and somebody is harassing them to sell it, promising basically to do everything but leave a bag of cash at the door for reduced value just to get at it, particularly in the market being as hot as it is now. There's a ton of that. To John's comment, I mean, a irrevocable trust or a living trust is almost a blank slate. You can choose to set these up however you like. So if you have concerns about your kids, if you don't want them to get the money to a certain age, we haven't really talked about a distinction between commercial and residential properties today, but I have clients that we've built out trust mechanisms because they hold significant amounts of commercial property, and they want those properties to be held because to them it's income streams to their kids. And this is all doable with trust planning. You just need to have the right conversation with the professionals, either in the legal realm, tax realm, and investment realm, prior to being in crisis mode to get these things set up.
So let me ask this, I would say last question, because I know we got to try to wrap up here, but if you have a follow-up, please.
I got one more question for Jeff before he goes. Okay, great. So this one's really important, and our viewers have been asking about this, and that is, I have my properties owned in a land trust. Does the land trust give me the same estate planning or succession planning as a revocable trust?
A land trust can give you similar succession planning to a revocable trust. Your issue there being that the land trust is only to hold real estate. We have written some complicated land trusts over the years. By and large, the possibility of the trust holding the property in perpetuity, if it's an income property, goes down if it's in a land trust. But if property is owned in a land trust and it is done correctly, you can avoid probate.
So let me ask this final question. Does it matter about the portfolio size? So for instance, if all of my assets and I'm able to exceed, I'm going to say $6 million I can hit compared to $4 million. And I thought you told me there was, at one point, the $5 million mark was if your assets are greater than $5 million, now there's death tax or estate tax or?
So there's federal estate tax.
Okay.
If your assets exceed, it's about $11.5 million per spouse, and you get to combine those for two spouses. At that point, you need to have a conversation with your estate planner and your tax planner about estate taxes. Federal estate taxes can get rather onerous. The rate is very high. It's pushing 40%. That's a complex discussion to have with your estate planner and your tax planner.
It's a great conversation.
But that's going to be a great segue into our next episode with BJ, where we're going to talk about taxes, we're going to talk about real estate accounting, we're going to talk about all that. And then, of course, the IRA piece, which is my favorite in my world, which is IRAs avoid probate as well. So when we talked about Kevin and Cynthia with their Roth IRAs, now the estate amount, we do have to factor that in. But by and large, our IRAs avoid probate. And we can also leave our IRAs to our Rev Trust, right? Our living trust.
Correct.
Now, there are pros and cons in terms of doing that, which we'll talk about in another episode. But I think as viewers can start to see here, everything starts to come into the fold in terms of some actionable steps. So I think, James, actionable steps for our viewers today. Number one, start the process of forming the right entity or entities. Before you go out and start making investments. You know you're going to invest, you know you're going to take action, get started, so that you don't have all those costly mistakes. And for those that have properties, they've already bought some real estate in their name, that's okay. It's never too late. It's time to go and meet with an attorney, local attorney, to wherever marketplace you're in, and start talking about not just the asset protection, but also the estate planning piece. So that's all I got in terms of conclusions.
That's perfect.
Closing remarks.
We appreciate Jeff Grant from the law firm of Grant, Crochet, Muller, Myers in Naples, Florida. As always, if folks are watching this all across the country, find a great local attorney. But if you're in Florida, obviously Jeff Grant is here, and we're going to absolutely have Jeff back again because we wanted to do the real estate attorney and the tax accountant on the same panel just to have these conversations because we figure that's what real estate investors want to be able to hear, right? So listen, before we wrap up, Jeff Grant, John Bowens loves the fact that we have our segments on the Building Equity podcast, and we have This Day in Real Estate Investing History, and this is a really good one, okay? But this segment is brought to you by Equity Trust. So unleash your inner real estate mogul. Discover your potential as an investor by maximizing the power and possibilities of buying and selling real estate with your retirement account. U.S. News calls them the top 7 IRA accounts for 2022. Investopedia says best overall self-directed IRA company with $34 billion in assets under custody. Start the conversation today at trustetc.com. So this is an exciting one, John, because this one today is from July the 16th, 1705. It's an advertisement from the Boston Newsletter. And what I love about in 1705, the colonial writing, is anything with an F that literally looks like an F is actually an S. But this is going on here. It's like Edward Bromfield and Paul Dudley, Esquires, administrators to the estate of James Gray, late of Boston, peddler, deceased, due by the direction of the Honorable Isaac Addington, Esquire, judge of probate and wills. This is what we talked about today, was probate, with a Florida attorney. We're back in history here.
300
John.
years ago.
It's happening then too. Granting letters of administration. Do you still use letters of administration?
Absolutely. Letters of administration is still the term used today for the authority that's given to an executor or personal representative. In Florida, we use the term personal representative, but they mean fundamentally the same thing. And letters of administration is basically your court order saying that so-and-so is the personal representative of this estate and they have full authority to administer it. A lot of our clients get confused because it looks absolutely nothing like a letter. It's a court order.
And that personal representative has the ability to sign the deed.
Correct. That's
and
how
transfer the property.
Absolutely.
Right? So I love it. 1705, we're still talking about the same stuff 300 plus years later, right?
You probably studied this in law school.
Yes, absolutely.
You had to do a lot of studying in law school?
Just a little bit.
All right. Well, listen, thank you so much for being here. Jeff Grant, a Florida attorney from the law firm of Grant, Cottrell, Miller, Myers, joining us on Building Equity. John, I look forward to the next one. It's going to be exciting because we're going to start talking about tax preparation, tax savings, and then we're going to bring Jeff back again.
That's my favorite.
Excellent.